Good evening. Almas and Refinitiv are back with another webinar on a very interesting topic. Interesting topic. India unfolds inclusion in global bond indexes. We have Ruchit Kenya. She's an accounts manager at Refinitiv, London Stock Exchange Group Business in Mumbai office. Ruchita has held roles in FX trading, derivatives, and risk management. Ruchita is a chartered accountant by qualification and holds diploma in treasury risk management. She is giving welcome talk. Over to Ruchita.
Thank you, sir. A very good afternoon to all the participants today, and it is my great pleasure to welcome you all to Almis Risk Consulting and Refinitiv's live webinar on the very exciting topic, India Unfolds, Inclusion in Global Bond Indices. Refinitiv is a London Stock Exchange Group business, one of the world's largest providers of financial markets data and infrastructure, enabling customers to execute critical investing, trading, and risk decisions with confidence. Refinitiv has developed and refined a set of fixed income data tools and solutions which offer significant help to traders as they strive to access quality data, make sense of this data, thereby improving their efficiency and ultimately enabling them to make better decisions. Refinitiv offers a comprehensive range of fixed income data, and through the various partnerships with other best-in-class fixed income data providers, has expanded the scope of the offering beyond their own data content to include some of the most powerful solutions available on the market today. Refinitiv's impressive list of partners includes well-recognized best-in-class data providers such as TradeWeb, DealerWeb, Market Access, Tradition, iCap, Tullett Tribon, GFI, etc. Refinitiv's IFR markets content delivers across-the-board fixed income, global credit markets, and currencies coverage, including major government bond markets, investment-grade credit, high-yield emerging markets, mortgage and asset-backed securities, interest rate swaps, and major foreign currency pairs. Almis Risk Consulting, Mumbai, is a risk management company whose specific focus is delivering complete tactical and operational solutions to clients that focuses on foreign exchange treasury, covering currency rate risks, related interest rate risks, and commodity rate risks. Customers can choose to outsource their entire forex treasury, front office, middle office, and back office, or components of each activity being performed on technology management system. The Almis team and partners possess corporate treasury expertise as well as financial markets knowledge, both technical and fundamental knowledge. Almis's partners have wide and rich experience in banks, including public sector, private sector, as well as foreign banks and corporate treasuries. On the other hand, Almis Academy and Refinitiv both continue to respond to the market participants' need to stay abreast key developments in financial markets by creating and delivering relevant content via the education initiatives. For this purpose, Almis conducts the annual Rupee Money Conference. I'll share with you a few key highlights of this year's webinars, which include the LIBOR webinar, which was held in May 2021, an insight on oil, cotton, and soya conducted in July 21, and most recently, a webinar on the central bank digital currencies, which was held in September 2021. Please stay tuned for more upcoming exciting webinars and events by both these companies. Now, coming to today's topic on the inclusion of India in global bond indices. Everybody knows India has aspired to become part of the global bond indices since 2014. Yet, it is among the last of the large investment-grade rated developing economies whose government bonds are not yet a part of global bond indices. This, in spite of having one of the largest bond markets among emerging market economies with more than $800 billion in debt stock. Although investment in Indian stocks have been preferred by foreign investors, bonds so far haven't met with the same enthusiasm, which can be accounted for a variety of factors, such as the government's less than transparent accounting, partial capital controls, the cap on quantity of bonds that foreign investors can own, which stands at 6% of outstanding debt stock for government securities currently, and so on. The RBI, together with the government, is making efforts to enable international settlement of transactions in government securities through international central securities depositories. To quote RBI Governor Shaktikanta Das, once operationalized, this will enhance access of non-residents to the GSEX market, as will the inclusion of Indian GSEX in global bond indices, for which efforts are ongoing. Clearly, the environment and interest for this is present. We are aware that long-held restrictions on foreign buying of its bonds have kept India out of the top benchmarks used by global money managers. Therefore, an inclusion through a clearly communicated and sequenced series of reforms and the easing of restrictions could herald a landmark change. In today's discussion with our esteemed speakers, we aim to address this topic holistically with nuances around the need for inclusion in global bond indices and its importance in the post-COVID-19 world, the fully accessible route for foreign investors, what factors are behind the step for securing access to global bond investors' capital, and the impact that it can have. We will also be looking at market accessibility and other hurdles for investments in Indian government bonds, eligibility of debt settlement through international settlements platforms, and resolution of taxation-related issues. We will be looking at implications of inclusion on the INR, on sovereign credit, onshore corporate bond market, as well as the equities world. Last, we'll be looking at benefits in terms of cost of capital to the non-large corporates as well as government enterprises. On that note, I sincerely hope you will enjoy the session today and take back perspective on what is potentially a move that will reposition India in the global financial landscape and have far-reaching changes on the economy. Thank you for your participation. And now, it is my great honor to introduce you to our keynote speaker for today, Shri G. Mahalingam, full-time member, SEBI. Welcome, sir. Mr. Gurumurthy Mahalingam is a whole-time member, executive board member of Securities and Exchange Board of India, SEBI, looking after Market Regulation Department, Commodity Derivatives Market Regulation Department, Foreign Portfolio Investors, Investigations Departments, and the Office of Investor Assistance and Education. Mr. Mahalingam is also at present a member of the Board of Governors of National Institute of Securities Market. Prior to this current assignment, Mr. Mahalingam was an executive director in the Reserve Bank of India, looking after the market operations, both rupee liquidity and forex operations. In his stint of 34 years with RBI, he has taken on varied roles like Chief Forex Dealer, Chief Investment Dealer for Forex Reserves Management, Head of Debt Management. Sir has also been actively involved in regulation and development of money, bond, and foreign exchange and derivative markets in India. His prior assignments in RBI include bank examiner, as also a member of the teaching faculty in RBI's Officers Training College. Many of you may have benefited from Sir's teachings in that capacity. Mr. Mahalingam holds a master's degree in statistics and operations research from the Indian Institute of Technology, Kanpur, and an MBA in international banking and finance from the Birmingham Business School, United Kingdom. And now, without further ado, I hand over to Mr. Mahalingam to address the participants. Thank you.
Thanks a lot, Ruchita. Thank you, Mr. Viju, for this invite. I'm extremely happy that Refinitiv and Almas put together. They are organizing a conference which is pretty timely, coming in the wake of RBI Governor's announcement about India's inclusion as a part of the global bond index. My idea is to just introduce a subject. I'm not going to go too much beyond the subject, because I know we have star speakers waiting to give their views, for which I will also be hearing what they want to say about it. I would just give you an idea about the policy environment, which was at that point of time when a serious conversation began in Reserve Bank of India about including India in the bond index. The serious conversation can be traced back to 2013-14, when Mr. Dr. Raghuram Rajan was the governor of the Reserve Bank of India. We had at that point of time 2 or 3 rounds of discussions with some of the bond index providers at that point of time. But then we couldn't really make a breakthrough for a variety of reasons. Number one, and rightly pointed out by Ruchita and Mr. Bijur also, was that the limits on the government bonds. Even today, we have the limits on the government bonds. So the bond indices people said that unless India is able to remove those limits, India cannot become a part of it. So we were also thinking from the angle of capital account convertibility. India wanted to have its own calibration as far as the capital account convertibility is concerned, and not to be dictated by the policy constraints which could be imposed because of the India getting included in the bond index. The third, of course, is the kind of capital flows that would come in, but that I'm going to cover a little later. But that was also a part of the concern or the worry or the policy challenge at that point of time. Now, the question that could be asked is, why is India right now thinking about it? I mean, when it had gone back in 2013-14, how is it that India is able to bring this subject back on the table? I would attribute that to, I think, a reasonable semblance of macroeconomic stability in the country today, whether it is in terms of GDP growth after COVID or whether in terms of inflation. I think we are reasonably in a good position today. But there are, I mean, some pinpricks which are still there. One is in the form of fisc. We are not very sure how the fisc is going to pan out in the wake of COVID and the government's enormous spending. And this spending was warranted. I mean, nobody could have controlled this spending at all. So this is completely out of control. So this, how is it going to pan out and how are we going to manage this kind of a spending is something which is going to be very, very important for us to watch. A third factor, apart from the macroeconomic stability domestic, I think the external sector stability, that played a very important role in taking a policy call here. If you look at the current account deficit has been well contained, almost close to or below 2%. I won't really look at the current account surpluses that we recorded off and on, because in my opinion, these are not sustainable. India is a current account deficit country, and the current account deficit will continue for quite some time to come, being a very heavy oil importer. Second, the foreign exchange reserves have gone up to close to about 630, I mean, it is zooming towards $650 billion. It's unprecedented. And in terms of number of months of imports, we are now just, I think, barely crossed about 15 months of imports. I cannot remember, at least in my professional service period, India reaching this kind of a level at any point of time, with the imports doing, I mean, reasonably well, not exceedingly well. On the external debt front again, I think for the last few days, we have been seeing that the foreign exchange reserves are ahead of the external debt in terms of numbers. Of course, it doesn't mean much for India, for the reason that when you talk about the foreign exchange reserves of India, they are all owed reserves. They are not owned reserves at all. So to that extent that a good part of the foreign exchange reserves have been accumulated out of the capital flows which are coming into the country, these are something which can go back at any point of time. So keeping these aspects in mind and the debt profile overall, where the short-term debt profile is still not a very uncomfortable picture. So I would put it that the policymakers took a call now that the situation is much, much better right now compared to what it was some time back, to open up as far as India's participation in the global bond index is concerned. Now, on the main thing is about the fisc, whether the fisc is going to get on track within a short period of time. This is, I'm not too sure how it is going to be managed, but things should pan out well if on the growth front, if India is able to pick up traction. And in the next few years, if India is able to record a decent growth, I'm sure with some amount of fiscal control, I think we should be able to achieve the fiscal targets that we have in mind. Although definitely we had aimed for it much, much before, but COVID has come and derailed quite a few things here. Now, given the other factor that I was talking about, capital account convertibility. Now, are we going to be either fast forwarding capital account convertibility by this, or are we getting derailed on our track of calibration? Well, my thing is, this is one of the instruments of capital account convertibility. I mean, we are opening up capital account step by step. So I would say this is clearly a step in the right direction, that to that extent, the capital account is going to be opened when the bond indices are open, bond indices inclusion is policy is made, and people are allowed to come in without any limits, at least as far as certain bonds are concerned. Now, I would like to focus a little bit on the challenges which are going to come about because of this in the wake of this inclusion for the policymakers, as well as the benefits. Benefits clearly, well, I have not done an estimate of how much money is going to flow in, but I have been reading in the newspapers for the last about few days that we can expect close to about $250 billion in the country in the next about 10 years' time. Well, I'm not there to validate these estimates, but then assuming that, okay, there are lots and lots of passive funds which are operating outside. And these passive funds, if India is going to be included in the index, they will definitely have a share of the cake. So that's going to bring in certainly some amount of flows into the country. Whether it is going to be 100 billion or 200 million, I won't like to venture to make a guess at that. But certainly, this has its own kind of policy benefits as well as policy challenges. Policy benefits on the angle that the capital for India is a capital scarce country. So the capital flowing in is going to be always beneficial. But then I'm not sure whether we are going to find the right use for this capital in terms of the growth getting propelled to such an extent that this capital could be used for financing the infrastructure. Because our infrastructure needs are more of domestic needs, they cannot be financed more out of imports. But to the extent that the infrastructure could be financed out of imports, this capital could be very well used by the policymakers. A second most important challenge for the policymakers here is arising from the Reserve Bank's management of rupee. Now, this has been always a problem from the angle that there was a feeling, I mean, taking a cue from 2013, when in a space of about 3 months, India experienced an outflows on the bond front to the extent of almost about 11 to 12 billion dollars. This has been a scarecrow for India. We were always wondering whether we would be able to manage that kind of outflows at any point of time. Now, this can very well happen if the passive funds which have invested in India at some point of time, India's weightage is going to get cut even by a few basis points. To that extent, for rebalancing, people would like to move the funds out of India. Are we prepared for it? That's a question that we need to ask. Now, to answer this question, I think we have to look at when we talk about the tumult that could come about in the financial markets because of these kinds of outflows, whether Reserve Bank is equipped well enough to fight these kind of flows which are getting out of the country. In my view, with about $650 billion, or to be precise, $630 billion in their coffers, I think perhaps the time is, we cannot find a better time compared to today to fight these kinds of outflows. I'm not talking about fighting the outflows. I'm talking about balancing the outflows and to ensure that rupee is going to be on a stable regime. Of course, when such kind of policy measures are going to be initiated, it's going to have a cascading impact on the liquidity, no doubt about it at all. So in the first instance, when we are talking about a huge amount of inflows into the country, and if the Reserve Bank intervenes to stem these inflows, a huge amount of liquidity infusion is going to take place. And on the contrary, if there is a huge outflow which is taking place, again, Reserve Bank intervenes to actually stabilize the rupee. Again, a huge amount of liquidity absorption is going to take place. But in my view, we have managed these situations in the past fairly well. And we are generally in Reserve Bank, whenever there are huge amount of outflows, given the foreign exchange reserves are a little limited, I mean, when we were at about $300 billion and all, we always felt that we are constrained from the angle of actually trying to manage the rupee fairly well. But as far as managing the capital inflows are concerned, I think India has found out ways of managing capital inflows. I think we can trace back to 2004 when the market stabilization scheme was introduced. It was a real innovation on the part of India that a huge amount of capital flows could be absorbed by bonds being floated by the government of India, the cost of the bonds being actually absorbed by the government of India, but the operations being done on behalf of Reserve Bank. So that was an excellent picture of coordination between the Reserve Bank and the central government, that the MSS scheme of 2004 really came to the rescue of the country in terms of actually trying to absorb all the flows without causing too much of policy problems as far as the macroeconomic policy maker is concerned. Now, do I have some suggestions as far as this particular thing is concerned? Again, I'm going to look forward to the speakers as to what they would say as far as this opening up the inclusion is concerned. But I was having my own thoughts on the FPI front. I think we have done quite a few innovations in the recent past. Now, if you look at the voluntary retention route, I think this was something which was cooking for quite some time within the Reserve Bank of India as well as the government. But finally, they announced it in 2019. And in my view, it's a very, very innovative instrument, which has been put on the table with the kind of tweaks, with the kind of controls that are necessary to put them in. I still remember there were critics who said that the voluntary retention route is going to be doomed to be a failure. But somehow I was feeling that the voluntary retention route is an option available to the Reserve Bank of India and the policy makers. And we are not forcing something upon the guy who is entering the country. We are giving him an option. So if he wants to come into the country and he is prepared to stay in the country for 3 years, he is not bound by some of the restrictions which are otherwise clamped on the foreign portfolio investors. So it's a question of give and take. If you are prepared to reside in the country for a longish period of time, you can take the benefit of certain restrictions not being clamped upon you. And I thought this was an excellent bargain that the Reserve Bank was striking in terms of voluntary retention route. While originally the response for this was looking a little lackluster, today, going by whatever we are saying for quite some time, I think the response is pretty good. In fact, my suggestion to the policy makers would be, do we need to really think of limits under this voluntary retention route any longer? We are opening up, the 5-year, 10-year, 30-year bonds in the FAR route, fully accessible route. If we can take out the limits in the fully accessible route, I'm not sure what is really hindering us from taking out the limits in the VRR route. And the VRR route, since it is going to bring in a kind of a stable flows into the country, and we are very clear about the ladder of maturities of these flows, that the policy can be tweaked according to that. My preference is that VRR limits is something where the Reserve Bank has to review. Perhaps the limits can be given a go by, or in a calibrated fashion, they can actually take the limits out. This is one thing that I would lay on the table for even the speakers to react, as well as the Reserve Bank to consider. A second thing that I have been advocating even in the previous ALMS conferences, which is not found too many takers, at least amongst the economists, is that should India go in for sovereign borrowing? Now if we are opening up on the bond front, and if we have considered the VRR route, and we have considered the FAR route, I think it is time we take this up. Now, this is something which is very important from the angle. I would like to outline just 2 or 3 things here, just to substantiate my point. In fact, this was announced as a part of the year before last budget, but then it was never activated. It was withdrawn. It was taken back. It was almost like a shock and awe measure at that point of time. People did not believe that this could ever happen in India at all. But I asked a simple and straight question. Can we get a better time to borrow in the international markets? When the rates are at rock bottom, when the US 10-year is available at 1.3, when generally the liquidity is in surplus all over the world, are we ever going to get better times borrowing abroad? But then the counter question asked is, can we leave this tool in the hands of the government? It's like an atom bomb. It can be misused. But then every economic measure is an atom bomb. You cannot say that this measure is a bomb, this measure is not a bomb. Now, for every measure, the parliament always enacts some sets of controls. Even in US, they have a debt ceiling. Why can't we have a ceiling that out of the sovereign borrowings of so much, 10% could be calibrated for this? Even when the budget announcement was made a couple of years back, clearly the announcement in the budget was about 70, if I remember correctly, it was about 70,000 crores was said to be borrowed. And in my opinion, that was a very well calibrated figure. And we can come up with such calibrated figures of sovereign borrowings because we are not going to get these kinds of times all the time. Second, the cost of sovereign borrowings. As I mentioned, with the 10-year yield going at 1.3 and assume a spread of another about 250, 300 basis points in the Indian sovereign borrowing, India has an opportunity to borrow at a much lower cost than in the domestic market. And to that extent, the space here for borrowing gets vacated and the others could enter that space. I'm not saying that the government is completely crowding out the borrowing space, but then we need to remember that if there is another avenue available, and this is the best time to examine this avenue, I have a feeling the policymakers would like to look at it, should look at it. Then the third question asked is, if tomorrow the rupee is going to depreciate and the entire borrowing bulges in terms of the rupee outflows, the rupee expenditure on the part of the government, how is the government going to manage it? Can they not hedge it? If they hedge it, the hedge cost plus the original cost of US borrowings, does it really leave any advantage on the table? I very strongly beg to differ here. My difference of opinion arises out of the fact that we need to look at how the rupee has been depreciating ever since it was left free in 1993-94. From a level of 31.37 today, if we have reached a level of 73, and you work out a compounded average annual rate of depreciation, it comes to 3.1%. So I will ask the question to the sovereign, is there a need to hedge at all? Now then, people will ask the question, are you advocating that sovereign should speculate, but the corporate should not speculate? Well, the answer to this question is speculation or the hedging as an instrument is certainly not available to be used by the central banker or the central government. I think they are going to calibrate that only about 10% of the borrowings, a certain quantum of borrowings is going to be resorted to from abroad. You don't need to resort to the hedge because the average annual depreciation of the rupee has been 3.1. At some times, okay, the rupee curve is very zigzag. It goes up, it comes down. So if the repayment is going to happen at that point of time, perhaps, obviously, the country is going to pay through its nose. But then not all times when the rupee is going to depreciate, that the repayment is going to fall due. There are other times when the repayment is also going to fall due. So on an average, if we think that the rupee is going to be depreciating at about 3.1%, I think we don't need to have any apprehensions on that front. It's the best time to experiment with the sovereign borrowing, which will create a good amount of space within the country. And that is something I think which we need to look at. And I finish with the last point. Vis-a-vis the foreign portfolio investors being allowed to invest in the rupee bonds in India, and comparing that with Indian sovereign borrowing abroad, I would certainly prefer Indian sovereign borrowing abroad, because the foreign portfolio investors actually coming and borrowing in India, investing in India in the rupee bonds is actually subjected to sudden stops. They can withdraw at any point of time, create a huge volatility as far as the interest rate market is concerned and the exchange rate market is concerned. But the Indian sovereign borrowings are going to be for a contractual period of maturity. That's not going to bring in that kind of a volatility as far as the Indian policymakers are concerned. Thank you very much, Almas. Thank you very much, Refinitiv, for this opportunity. Yeah, thank you.
Thank you, sir. Great. That was sublime, like it always have been. It was a great honor to listen to you, sir. Before we proceed further, I, on behalf of Almas Consulting, would like to welcome all of you to this webinar and convey my gratitude for allocating as well investing your time. We believe we have something of a great value for you in store. A special thanks to Mahalingam sir again for sharing his insights and thoughts. I would like to highlight a few things before we proceed further on various discussion points of our webinar today. The whole process of getting included in bond index began somewhere in 2014, post taper tantrum crisis in 2013. India has taken several steps, as being highlighted by Mahalingam sir, to get included in indices, such as simplification of registration, introduction of a VRR route, allowing route for foreign investors without any limits, and now need to clear hurdles of eligibility of debt settlement through ICDs, International Custodian Settlement Platforms, and resolution of taxation related issues. The milestone is likely to complete in next 2 to 3 quarters. Once the induction of Indian government bonds in indices like JP Morgan Emerging Market Debt Index and Bloomberg Global Aggregator Index happens, India will start seeing passive flows, participation in Indian government bonds. Since these indices are being used as a benchmark for performance and are closely tracked by active investors, it is more likely that additional flows would be invested into Indian government bonds. With this development in place, I'm very sure that we will also see global insurance companies, pension fund, and other sovereign funds following the trend of investing in IGBs. We have all seen the equity market has been an attractive destination for foreign portfolio investors. The total FII flows in last 10 years is around $115 billion in equity segment. This inclusion enables Indian government bonds to be a meaningful part of the FPI investment portfolio too. The current ownership of foreign investors, as being already said by Ruchita and Malingam sir, in Indian government bonds is barely 2%, which is actually far lower than the 6% limit fixed in general category by India. If we see in reality, FPIs have reduced their investment in Indian government bonds after 2017, despite the pros of higher nominal yields, inflation targeting framework, increasing FX reserves, and much simplified process of investments. I think the reasonable explanation of the same could be negative real rates in India, higher fiscal deficit, as well as I believe that significant chunk of investment flows deployed in China post their inclusion in the global indices. There are enough securities available for eligible 5, 10, and 30 years, amounting approx USD $200 billion. Every year, we are expecting that USD $50 to $60 billion will be added to that pool. So there are significant securities would be available to get this investment flow absorbed. We believe that the inclusion will impact Indian financial markets in multiple ways. To name a few, it shall provide sticky FX flows, increase in forex reserves, while we'd also see a new set of investors for government bonds, ultimately resulting into a better debt sustainability. We believe that balance of payments would get better, which shall eventually reduce cost of capital, resulting in a much better credit growth. Once FPI investment increase in Indian government bonds, active investors may start looking or increasing their participation in corporate bonds as well. All of us know that our PSU banks hold very excessive SLR, Indian government bonds. If this happen, this indices thing happen, we believe that the money will get out of these bonds will get out of the government banks and might rush it to these FPI investors, and that will release money for our corporate borrowers from the PSU banks. And all of us are very, very certain that in India, if you need a long-term capital, long-term borrowing, PSU banks are the last resort. And if they get that money, that will help to build up the infrastructure. The current FPI flow is at 1.9%. And as the reports are highlighting that we might reach to 8 to 9% in next 10 years. Whereas the current holdings in other countries such as Indonesia, Mexico, and Brazil are more than 20 or 40% respectively. So that clearly gives that there is enough space available. Though India fares better on external front, it also lacked steam on a fiscal matrices when compared with the other peers. That is negative for India. Just to highlight the other side of it, the bond and currency volatility will increase in case downgrade happens. Just it had happened for South Africa 2 years back. The 10-year yield went up by almost 2% and currency depreciated by 25%. I cannot allocate how much it happened due to the downgrade because at the same point of time, pandemic also happened. Though there could not be enough set of implications that we can arrive at. To discuss more of this and with perspective from different eyes of a global index company, economist and fund manager, I would like to introduce my fellow panelist speaker. To begin with, Manish Gupta. Manish Gupta works with FTSE Russell since 2012 in the Research and Analytics Division. With experience and knowledge of multiple assets, has worked extensively on fixed income, equities, currency, and strategy indices. He is currently part of the fixed income and multi-asset product and research team, including working on evaluating market accessibility for Indian government bonds to foreign investors as part of a FTSE fixed income country classification framework. Over to you, Manish.
Thank you, Mr. Rathi, and thank you, Mr. Malingam. It was really encouraging to hear your views, especially from Mr. Malingam, who's also part of Indian regulatory framework, and his views on, his open views of how India can and should allow foreign investments and be more accessible. These are the kind of views that we don't really see outside in the outside world. I must say that. In fact, I plan to play a bit of a devil's advocate during this webinar. So I'll probably highlight more of things that we hear from international investors. And I believe that this opportunity that you, Almas and Refinitiv, have put together to discuss openly the risks and opportunities of foreign investments in India. We should organize more of these, especially with international investors, because at the moment, my experience tells me or shows me that India lacks in this kind of activity. We talk a lot about, Indian economy and prospects of India, but mostly we talk within India. We don't engage as much with the people who are going to invest. And that's why there is a lack of knowledge around the world about what India really has to offer and our critical systems. So, for example, I put out a blog a few months ago on India, especially when we launched our FTSE Indian Government FAR Index, in that I highlighted the technological advancements that India has made in the capital markets, which are, I would say, second to none. But you don't see that people talking about that in the international community. And same thing happens about, you hear a lot about negative about India in international news and not so much what positive is. And that is, again, I think the result that we do not engage so much with international participants. So, for example, there was a lot of hesitation on part of international investors when retrospective tax came into being back in 2012. And that still sits in the minds of the international investors, even though currently government has legislated that, that they are withdrawing this legislation and, making good on their promises to Kane and Vodafone. But these kind of things remain, and they remain, again, repeating what I've just said, is lack of engagement with the investors. Having said that, I would just like to go through or highlight, say something about FTSE Russell and the country classification framework that we have. So FTSE Russell or rather FTSE came into being in 1995 as a joint venture between Financial Times newspaper or the owners of Financial Times, the Pearson Group, and London Stock Exchange. And that's how the FTSE got its name as FTSE, Financial Times Stock Exchange, basically. And that is now just an acronym because the company is now 100% owned by London Stock Exchange Group. Within FTSE, we compute more than 250,000 indices per day. And there are about $18 trillion of money is benchmarked against our indices, which makes us the leader in this space. There are, although, as I said, the company was started in 1995, we can trace our roots back to 1930 with the formation of Actuaries Investment Index in the 1930s. So that's how back almost 100 years of history as far as indices are concerned. And indices are quite important in the way that they help benchmark and the investors of their performance. And also one very important aspect, which was also touched upon earlier by Mr. Malingam himself, is about active and passive investment. So with the help of indices, passive investment has taken up a huge amount of market share. In fact, in US, the market share of passive investors is about 48%, and 52% is with the active investors. And that is because the research has shown that although active investment may show on paper high returns, if you take into account the costs involved, then they barely beat the market. And thanks to funds like Vanguard and BlackRock, the investments using passive funds are much cheaper, and they provide more opportunities and choices to the investors at a much lesser cost. And because through the indexes, we have actually, to a large extent, quantified most of the research that active managers did. So it is a rule-based investment now, and the rules are very transparent, which any investor can read and replicate. So it's not something hidden or a black box kind of a process, which you sometimes find with active investors, where not enough transparency is available. So this is a kind of brief about FTSE. And moving on to our country classification. So our country classification framework came into being, we've always had the country classification framework on the equity side, but on the fixed income side, that came into being in 2019. Basically, as a distinguishing feature of multi-currency index benchmarks is their approach to local market inclusion. So we need to understand the markets, how they perform, what is their accessibility on different parameters. The parameters are market and macroeconomic regulation, foreign exchange market structure, bond market structure, and global settlement and custody. So these are broad parameters against which we judge against which we classify the countries. And based on their scoring within these parameters, they are defined, they're provided the accessibility level of 0, 1, and 2. 0 being the least accessible and 2 being the most accessible. So all the developed markets fall under accessibility 2, whereas the emerging markets have an accessibility level of 1, whereas other countries which we classify as frontiers are classified as level 0. Now, coming to talking specifically about India, within FTSE's framework classification, India is still at a level 0, although we did put it on a watch list for a possible upgrade to level 1, and we will be announcing, and the classification is reviewed every September and March, and the results are announced at the end of March and September. So there should be some announcements coming through at the end of this month, but I will not like to indicate what that will contain, because that is at the moment confidential information, and the process is still on. So, but definitely there will be some announcements later in the month about the future of the country's classification. But the problem with India at the moment is that it is not in any of the bond market global indices. Although we do have frontier indices, but India is kind of an orphan, I would say, at the moment from that perspective, because it is not in the frontier indices because it is too large to be in that category. And it is not in the emerging market indices because of the accessibility level restrictions. So I think I would like to, although India does have a lot of positives, but there are a lot of restrictions as well, some of which Mr. Malingam and Mr. Rathi pointed out themselves. So, but yeah, and I don't want to take more time talking about this at this point in time, and give everybody an opportunity. Plus, we can. I think we'll have a Q&A session later on. So, I would like to address there at that point in time. Thank you very much.
Thanks, Manish. Thanks for your insights. I got one important point that India lacks on listening and interacting with the investors. And I think appropriate authority will listen to it and will act on it. Now I move on to Rajni. Rajni Thakur brings more than 20 years of experience across policy, consulting, and banking domain. She brings a unique blend of her knowledge and experience on brought from her various stints in India, Middle East, and UK market. She has built in a reputation of her specialist advice based on application of her data and statistics and her understanding of economic relationships to uncover latent trends that are useful to various organizations. She is actively involved in various global professional women platforms, including Lean in Circles and Elevate Network. She holds MA Economics from Delhi School of Economics and also an MSc Finance degree from London Business School. Over to you, Rajni.
Thank you, Pankaj. Thank you, Vijay. Thank you, Almas and Mahalingam, sir, for this opportunity. It's really a pleasure to be part of this platform. When we started discussing this, the first thought that came to me as an economist is it's a huge step forward as an economy, as a market, as Manish was just indicating. It's too large a bond market to be part of Frontier group, and it's not present in the EM group because of lots of accessibility on different issues. So what does this really bring? I mean, where are we on the bond inclusion in terms of A, the assets, B, in terms of finally the potential gain to the economy? And that's a big question that as an economist I start tracking. So it's a big step, good leap of confidence, claiming its place in the global bond market. To that extent, all stars are aligning, and we have both the push and the pull factor currently working at the same time. We are one of the largest bond markets. There's increased flow, foreign flow in India, and lots of interest in becoming part of India growth story. Strong equity inflows that we have seen. Stable currency, as Mahalingam sir was indicating. Growth potential that many of these investors are looking at. And then domestically also, we kind of starting on a whole capex-led growth plan for next few years. So there's huge ask for growth capital at this point of time. And as an economy, if there's one factor of production that we've been short of for the longest time, it's capital. And then there is a whole bond supply dynamics evolving in terms of more borrowing coming from the government. So every which way stars are aligned, the timing is right. And probably for me as an economist, beyond the short-term exuberance of, if it were to happen, of being included in an index, maybe some passive flow and some sentiments and all that we get, and there's various estimates now available to what this could pan out. The actual gains are only incremental. So this, what I see, is a start of what could be probably a decade-long story. It's not something that brings in maybe initial bout of exuberance on different asset class, but the potential gains really work out in terms of growth capital, in terms of cheaper funds, in terms of currency stability, only incrementally. And that's something that I think has been missed in many of these discussions. There are lots of ask on the regulatory side, on the accessibility side, on operational side, for many of these flows to actually materialize in reality. So when we've seen, we already have a cap of 6%, as you mentioned, and the actual holding is running around 2 to 3%. So the big driver for me in this case is the growth story. For me, as long as we are a big growth story and everybody wants to get invested in India, is where it becomes relevant. And that makes it a very chicken and egg kind of a story. So you need capital for growth, and the capital comes in because it's chasing yield and it really wants the high growth potential. And we as an economy have missed our potential many, many times. So, we do have a central bank that's proactively engaged. There is a calibrated, very cautious approach towards working for whatever are the asks on the regulatory, on the accessibility, on different tasks. So I'm not worried a lot about the potential risks that could play out. We've seen that in equity market opening up as well. We really managed to handle the risk very, very well. What I'm worried about is that it's a long-term story. The potential gains really work incrementally over next 5 to 10 years, not really immediately, even if we were to be included in the bond index. And as Mahalingam sir kind of pointed out, at this point of time, if we need growth capital to keep our macro story intact, then probably government going out and borrowing, this is the best time for do it. So that's something that I really strongly align with his views on that. And we do need internal growth story to be very, very strong for this kind of an interest in forex flows. We might increase, we might get included, we might have short-term flows, but for it to be sustainable and to tap on all the potential, act as a catalyst for growth capital, I think that's a long-term story that will play out only over incrementally over the next 5 to 10 years. And for our immediate need, we have to look at some other sources of funding to figure out how that works out. I'll stop here. I mean, we could go into details, but I'll stop here and back to you.
Yeah. Thanks, Rajni. Thanks to make us a distinction for what would be a short-term and what would be the long-term story. Flows come in and how the overall story unfolds. Thank you. Now we come closer to the fund manager, Mr. R. Sivakumar. R. Sivakumar is an engineer from IIT Madras and has a PGDM from IIM Ahmedabad. Over 19 years of experience in the Indian asset management industry across asset classes. He has got a previous experience with Sundaram Asset Management and Zurich, India. He currently working with the Axis Mutual Fund. Welcome, Siva.
Hi. Thanks for inviting me here. And at one level, I was wondering, why is it that an Indian fund manager managing largely Indian money is being invited to discuss a topic like FPI investments? We do have at Axis a partnership with Schroders. They have a 25% stake in Axis AMC, and we advise them also on their investments into India, both on equity and bonds. We advise them on an India-specific bond fund, which was launched back in 2019. So I have a little bit of experience working, looking at this from the other side, from what an international investor would look at investing in India. India is really not there in the global map when it comes to fixed income. We're simply not there. The point has been made that we are less than 2% or thereabouts of Indian bonds are owned by foreigners, and that compares to double-digit ownerships in most other emerging markets. We are just not there, and one of the reasons we are not there is because we are not there in indices. Benchmarks are extremely important, whether you are active or a passive investor. Benchmarks are extremely important for investors. If you're not part of a benchmark, then your allocations automatically become very small. So, even an active fund will take a small allocation. Of course, India is part of some Asian benchmarks, but those Asian funds are also much smaller. So, if you really want to make a mark in the global scheme of things as a fixed income destination, you certainly need to be a member of one of the large indices. I know that FTSE Russell, for example, manages. I think you guys manage the WIGBY, the Erstwhile City WIGBY. Getting to be a member of WIGBY is a long path. It probably requires many rating upgrades and so on. But if we don't, our aspiration as a country should be to be a member at the top seat, the first tier. All right, we're not going to be in WIGBY, but can we not be in the Bloomberg Global Aggregate? Can we not be there in JPM? And I think even FTSE's emerging market benchmarks. I think it's extremely important that we become members of these benchmarks because it brings us into the conversation. When I talk to foreign investors, I literally have to start with what is India, because fixed income investors, people know what is India. That's where you come to take pictures of elephants. But if you talk to fixed income investors overseas, nobody knows us. Nobody knows that yields in India are among the best among other BBB rated countries. Nobody knows that our currency is relatively stable compared to other BBB rated countries, and therefore on a carry adjusted, or currency adjusted or a hedge basis, we are probably better off investing in India than most other similar risk countries overseas. They just don't know. And why is it that they don't know? Because we are not there in the index. So I think the call of being a member of an index goes beyond just this kind of passive flows, which is being talked about in the press and various research reports. I think if we really want to be in the global, with the big boys, we really need to have an open capital market, open current account, and be a member at the top table. I've been in this market now for managing fixed income for more than 20 years. Overall, being in Indian asset management industry since the late 90s. And, this whole RBI's first report on capital account convertibility is something which was reasonably fresh when I started in this industry. More than 20 odd years since that report came out, we are still discussing whether to implement it. I think it's time we just take catch the bull by the horns and say, look, we have got a roadmap, we're going to do this. And it works both ways. Very few foreign investors have exposure to Indians, and Indians have virtually zero exposure to global debt. Why is it that we don't look at it from both angles? Why is it that we don't look at it and then say that Indian investors should be able to buy US government debt or Indonesian government debt? I mean, why not have a larger conversation? I think this whole talk about capital account, we cannot only look at it from the benefit of foreign investors investing into India, but also look at it from the perspective, what is it that we can do for Indian investors investing overseas? Second, an important point that Rajni and everybody else has made, including Mr. Mahalingam, about reducing the cost of capital and so on and so forth. But understand the capital need is actually of the private sector. How can we make sure that the same FAR type accessibility is made available for corporate bonds? It cannot be one rule for me and another rule for thee. I think as a policy, as a country, we need to have a serious conversation about the entire capital account story, so that investors overseas, when they look at India, they're looking not just at Indian government bonds, but also Indian corporate bonds. And again, another thing that has been going on for 20 odd years is this whole development of the Indian corporate bond market story. Let's get these topics out in the open. Let's bring the global best practices here. And one easy way of doing that is to actually start engaging globally to figure out what is it that works elsewhere and what is it therefore that we can implement here. And all of this is, I'm talking from a perspective of what is in it for us as a country. I don't care whether foreign investors make an extra buck or not. What really matters is, what are we doing for us? What can we do for our corporates who are looking to borrow money, as somebody mentioned already, the crowding out effects, etc. Can we not open up capital accessibility for Indian corporates for in terms of overseas funds, Indian investors to diversify their exposure into other currencies and so on. Mr. Malanga raised a very important point. Why not sovereign debt in overseas currencies? Why are we looking at this only from a perspective of Indian rupee debt accessibility? Because absolutely, when foreigners want to sell, let's say IGBs, they will need to sell that into India and repatriate the money, and that creates FX volatility. But if you have dollar-denominated debt, then one FPI sells to another FPI. There is no impact on currency. It's perfect. More importantly than that, it acts as a benchmark for corporate bond pricing. So once a sovereign issues and creates a dollar yield curve, it has massive implications for the rest of us. Right? I think the time has come that we look at this a lot more holistically, but coming very specific to this point about bond inclusion, I think the upsides far outweigh the risks. Going back 20 odd years ago, when the capital account convertibility story was first started, it's about the time that we experienced the Asian financial crisis. I think the Asian financial crisis is the reason why a lot of this capital account convertibility got pushed out. And then, occasionally you do get another crisis like 2008, and then again we delay things, and then we see a taper tantrum, and again we delay things. We always find an excuse to push these discussions forward. But I think that, when you look at these countries like Thailand, Malaysia, Indonesia, those all who got pummeled during the Asian financial crisis, and if you look at how they grew, let's say in the 10 years leading up, let's say 1986 to 1996, the kind of growth they saw in their GDP per capita relative to India, they all grew much faster. So despite the fact that they had a large crash, let's say you take a few years after the Asian financial crisis and you look at, let's say in 2002, 2003, 2004, and you look at the 15-year period, which includes a very, very large collapse, and you still find that GDP per capita measured in dollars, not measured in local currency, measured in dollars, was still significantly better than what we have seen in India. For most of them, Indonesia being, I think, a case in point where, because of their own challenges, they've had some difficulties. But most of the Asian countries, let's say between the mid 80s and mid 2000s, outperformed India on a dollar basis. It's, I mean, I think while we look back and we congratulate ourselves for missing the or for avoiding the downsides, what we miss is the fact that the upside that preceded that downside more than made up for that crash. And that net after the crash, you're still way ahead after being integrated with the global economy. I think we have, of course, we have benefited post 2003. The integration with the rest of the world has accelerated, especially in equity markets and broader economy. I think the time has come to extend that same benefit to bond markets too. Thank you, and I'll stop here and take a round table.
Thank you, Siva, and I can really look at that the way you have already put in across the importance of getting inducted in indices and the need which we have to access the foreign capital is more important for government and corporates both. Thanks a lot. So we are getting into a discussion mode, and I will start with the Mahalingam sir question itself. First one. What do you think of India borrowing through sovereign USD bond vis-a-vis local INR bond? I got some hint. And another question, the sub question of this is basically, what would be the ideal spread if India being a BBB minus rated, how much would be the spread over US treasuries? According to Siva, Rajni and Manish, you can take it up.
Sorry, my points in this are very straightforward. I think there is more upside than downside. I think there is at the outside, of course, it's fiscally beneficial because the cost can be lower. I think Mr. Malinga made that amply clear, both from a hedged and unhedged basis, and I think the government should be borrowing unhedged. But I think there's a significant value in just having a global benchmark issued by the Indian government. Yeah, in terms of costs, I think that today, of course, because yields are so low and credit spreads, in fact, are absurdly low. This is, it obviously is a very, very good time to do that. But when you look at from a strategy perspective, it doesn't matter what the levels are today. I think the government of India needs to look at this the same way they looked at, for example, as an example was given of MSS, market stabilization scheme was a point where the government actually took an explicit cost on its balance sheet. In order to develop or to create a tool. In much the same way, there needs to be a strategy to say, irrespective of the cost, and that cost could be higher or lower in a given year, we will need to have a constant stream of IGB overseas, whatever you want to call that ticker, issuance. And that should become part of policy of the government rather than based on a tactical view of the spread. It's like, the carve out that the government has done for floating rate securities now, right? It's instead of, earlier we used to have fits and starts. Some floating, some years will issue, sometimes you will not issue, and so on and so forth. Rather than that, have a policy and keep issuing, and then you will develop a market around it. In much the same, you need to develop a market. That's my view.
So I got you. It should be a strategic decision rather than a tactical one.
Yeah, I would actually echo Shiv Kumar's sentiments over here, because offering US dollar denominated debt also provides visibility to the country, and that what Shiv Kumar previously alluded to, about that people don't know about India, and and I also, as I mentioned, engagement with foreign investors. So this is another way of making India more visible in the international markets and to the international investors. For example, if we look at, when India allowed depository receipts for the equity shares, that provided so much more capital to Indian companies like Infosys, TCS, and others, and they could actually raise money outside India and develop the company's visibility and which helped them even get projects overseas much better, because more information about the companies was available, their balance sheets and their which were in line with internationally accepted accounting principles, GAAP, US GAAP, and others. So it is definitely a much more positive aspect to it. And again, going back to what Shiv Kumar said, is, providing that, having that confidence in ourselves to take that risk. We've always been hesitant to take that risk. And again, quoting the same, timelines, like in 1995-96, when we laid down the path for full convertibility of Indian rupee, and thanks to the currency crisis, we pulled out of it. We made rupee convertible on the current account, but didn't go all the way with on the capital account. And again, back 2003, 2004, when we were talking about India Shining campaign, we start well, but then something happens and we just, almost abandon it. And that kind of, it frustrates the international investors. That it's a start-stop kind of a thing. And the other thing that I would like to also address over here, what Sivkumarji said, is about, how much can India make out of this whole process? Definitely a lot for India to gain, but also foreign investors will come in only if they can make money. And if we continue to tweak our policies or change policies, which going forward, they don't make money, then they're not going to stick around. And this is the reason that even they are more happy to invest in China than in India, because they see upside there. They can make money out of this process. Thank you.
Thank you, Manish. Rajni, your thoughts?
So I think I pretty much covered my opinion in my first bit as well. From where I look at it, this is the time to claim our place in the global financial market. There's no reason that we shouldn't be forging ahead with something like this at this point of time. As the fellow panelists said, the upsides far kind of exceeds the risk. And currently, the global liquidity glut is there, and it's very, very easy to tap into it. Yields are low. This is the right time to step up and then experiment with it. I don't see much downside to this. And it's also a quick gain, so low hanging fruit in certain ways to fund the growth capital that we need in the economy. Then pushing for foreign investors to be investing in our bond. So for me, again, I think all for it.
Got you. We have, Malingam sir, we have got the views from all the three panelist speakers. I just want to highlight that Indonesia, which is a BBB country, and it borrows somewhere around 140 basis above, they have got a credit spread of 140 basis. So adding maybe another 10-15, we should be appropriately placed. That's my guess of our credit spread. So 160, 170 should be appropriate enough to raise funds abroad. Your thoughts, sir?
Well, I do agree with you as far as the spreads are concerned. But I would like to echo the views of Mr. Shivkumar here. I think we should be looking at a medium to long term rather than what is a short term today. So whatever may be the spread today, if there is a policy that we are going to borrow abroad on a regular basis, the costs are going to even out over a period of time. There could be spikes, off and on. There could be again lower costs at some point of time. But overall, if we manage to establish a yield curve, that's going to be a big economic good for the country. Ultimately, the corporates would be able to price off that yield curve, and the pricing will not be pretty vague or uncertain, and there will be a predictability about the pricing. So I'm talking about sovereign borrowing not as an one-off affair. It has to be a continuous thing. There has to be a continuous issuance process for that, so that the yield curve which is going to be established is pretty stable. That's what I wanted to say. Rather, I'm not into the job of estimating the yields, so I'm not really directly answering the question. I know you're not very happy with my answer.
I got you, sir. Okay, so next we move to basically whether the inclusion of bond indices, how does it impact our credit rating? Whether 28th, I think there's an announcement from Moody's also. Do we think there's some upgrade because overall the investor community is increasing for Indian bonds? How do you perceive that?
Again, I would say from a limited perspective, again, this is going to have a short-term impact. I don't think the rating agencies are going to look at it straight away and give an upgrade. They are going to look at how the fisc is going to be managed in India. How is the overall policy parameters which are going to pan out over the next few quarters in the wake of COVID and in the aftermath of COVID? And how are the political things, I mean, political stability is given in India, at least it is accepted by the foreign rating agencies. But how are things going to pan out on the political front, even on the other issues which have a huge amount of bearing as far as the economy is concerned? So my thing is, this is not going to be a solitary event which is going to bring about a huge change in the credit rating of the country at all. But nevertheless, it will add a small amount of positive as far as the country's rating is concerned.
Shiv-Kumar?
Yeah. So I don't want to say too much. I think Mr. Mangan covered this really well. But I'll just say that a couple of things. When you look at the India's ratings against other BBB countries, where we score better, where we score worse, by and large, we scored better than them on metrics already relating to the external sector, in terms of external liabilities, short-term liabilities, and so on and so forth. So I don't think external sector is something we need to fix when it comes to ratings. We score well there. We score well on growth. Where we score relatively poorly over time, one was inflation, which for a while looked like it was coming under control. In the last 2 years, it's again gone back to 6%, bit of a worry. And of course, we scored really poorly on fiscal metrics. If you want to fix or get an upgrade on ratings, what we need to do is get inflation back to 4%, which is RBI's target, and get the fisc back down to 3%. Both of them now look like more like a 3-year plus plan than anything which will happen in the near term. So I don't think ratings will be necessarily move, and certainly not move on the back of this any kind of bond inclusion.
Got you. Manish, the Indian budgeting system and Indian fiscal deficit, there are two ways people keep it. Basically, Indian budget has a on balance sheet and off balance sheet. Indian government guarantees a lot of debt issued by their subsidiaries, REC, PFCs, and NABARD type. How do we, the international community, would be seeing this?
Well, I think rather than from the international community, it is more about how much risk the government is taking. And if I remember correctly, back in 1999, when India conducted its nuclear tests and there were sanctions applied to the country, Indian corporates were finding it difficult to raise money internationally. And at the time, Indian government did come up with a proposal that they will guarantee those loans. But credit rating agencies said that please be careful because you will be taking risk by doing so. So the risk will be on government of India's books. So, that could result in a negative outlook for the country. So when it comes to ratings or these kind of things, it definitely impacts the amount of risk the government has its own books. Governments do, all around the world, governments do guarantee loans. Governments do help provide subsidies. Governments do, like the current crisis or mini crisis that is there in UK related to natural gas prices. So where, government is likely to help bail out some energy companies. So it's not something that is unique to India. It happens all around the world as and when the need arises. It's more about the discipline of doing these activities, the fiscal discipline that is very important, and how the money is spent, and how the money is raised, and how the money is spent. Is it spent on capital formation or is it spent on just paying the interest? So do you have a revenue expenditure or a capital expenditure, and what's the proportion of each? So these are the aspects that are looked at more broadly. Thank you.
Yeah, Rajni, would you like to add on this?
Yeah, I think pretty much echo what we've been discussing. My sense is that it's the other way. It's the rating upgrade that decides on the flows rather than flows deciding on any kind of a rating action. And as far as these rating agencies are concerned, it's not about the flows that they would worry about. They would worry about growth, inflation dynamics. They would worry about fiscal discipline. They would worry about debt matrix. So those are the things that are much more relevant than the bond flow inflow coming in. So I see the other way relationship rather than bonds or inclusion in bond in helping in any kind of a rating upgrade. It's the rating upgrade that will probably help us in more active domestic bond market with foreign investors. So that's how I look at it. And as far as the off-balance sheet items go, as Manish said, it's pretty much common everywhere. And as far as I'm aware of, most of these both international investors and credit agencies, they do factor in, and that's why we already now have a separate disclosure in budget documents as well onto what are the off-balance sheet items that we are borrowing on. So that's something that's a part and parcel across the globe. It's also a practice that might be relatively recent in India, but now we are pretty much factoring it, full disclosures around it, and also I don't see that as a major issue.
Got it. Thank you. So now we are getting into the final question. What will be the impact on rupee 10-year yield and overall short-term impact on the overall bond market? And my important question, which I always can't understand, why there would be a forward premiums are not reflecting the interest rate differential between two countries. Our MIFOR curve, our forward premium curve is in last 20 years of my experience have never reflected a interest rate differential. Whether these kind of inclusion and whether these kind of free flows can align those.
I think Pankaj, I would request you to start with the market guys and the economists. So that
Yes, sir.
Yeah.
I will start with Siva, sir.
So, to answer your second question, there is this, it's a classic nexus, right? Global bond yields plus FX hedging costs should be equal to local money market yields or local bond yields. But if you separate these investors, so for example, local money market is practically only invested by local investors who find it difficult to hedge and certainly have very little exposure to US money market yields or global money market yields. And global money market investors rarely able to participate and hedge their way or buy into Indian. So if you keep these markets separated using capital account convertibility rules, there is no reason for the hedge cost to reflect the interest rate differential because the two interest rate markets are kept separate from each other. And I think that's definitely playing into this whole game. So as we get more integrated, this bond derivative nexus will become more stronger. Bond currency derivative nexus, as it's called, will become stronger. So the bond markets and the currency markets and the forward markets, all of them will need to start aligning together. And that will happen. And in a way that is likely to lead to lower bond yields. To answer the earlier part of your question, what do you think will happen to bond yields? My expectation is that bond yields will start going down, or at least the spread to global yields will start decreasing as we get more integrated with the rest of the world. Can I make a prediction as to how much? I would not hazard to do that. Another thing I would also caution a lot of people who are listening to this and watching this webinar, don't get too excited that this is going to be leading to a large surge of inflows, which will cause a huge buying opportunity and that will cause yields to drop. I mean, today the RBI is doing open market operations, including the GSAP. And if you see a large surge of forex flows coming into buying GSECs, they will simply withdraw the GSAP. So there's no reason to expect that this is going to lead to a new source which will magically start depressing yields, right? So let's also be cautious about the impact on markets. This is not suddenly going to lead to a change in bond yields just because a new type of investor is coming into play.
Thank you, Siva. Yeah, Rajni.
Just to add my bit. So, I mean, I will again go back to what I kind of consider as an immediate, if we were to be included, of course, and as we move towards this whole inclusion discussion, we do see some extra flows coming in. So to the maximum potential that we are looking at, let's say on the passive fund flows immediately in Q1 or Q2 of next fiscal year, if we were, then we are estimating something around 3 to 5% kind of a gain on the currency side, and around 25 to 40 basis point on the yield curve. Back to what I was mentioning about, this is the short-term exuberance one time, this as we move towards it, lots of noise rather than actual lowering of yield curve and cost of capital in the country. Beyond that, as Shiva said, it remains to be seen how this pans out, and hence, it's very, very risky to gauge any estimate on how this will work out. It will depend on the actual flows that materialize, and that in turn will be a part of how the growth story pans out.
Thank you, Rajni.
Yeah, I think that makes perfect sense. And also we have to keep in our vision is that India is not the only country vying for these places. There are other countries like Egypt, Saudi Arabia, Vietnam, Kazakhstan. Everybody wants to be in the global indices. And the more countries come in, the India's weight will get lower, to which Malingamji, alluded to earlier, that could reduce the weight of India in the indices, and as a result, there will be rebalancing of the flows. But again, as Sikumarji mentioned, that if we want to be playing this game, then we have to think long term. It's not something, we think about it today and tomorrow something happens. Let's say just a simple thing that, India enters, along with that some other country enters, and as a result, the India's weight in the indices goes down. There are some outflows, and we do what we've done in the past. We, react to that, and we, start shutting down the doors. So we should be mindful of that.
Yeah,
Thank you.
just to quickly add my view on this, I think I would admire Rajni that she gave a real estimate of where the rupee is going to appreciate by about 2 to 3% and all. I would like to only give what could be the Reserve Bank's perspective there, more reflecting what Mr. Shivakumar was saying actually. Clearly, I think it's not that it is going to add a huge amount of liquidity to the entire economy just because the rupee appreciates and Reserve Bank steps in and it is going to inject more of rupee. After all, Reserve Bank has a target of money supply in mind. So the target of money supply, if it is going to be filled in through tap A, obviously tap B is not going to be open. If it is tap B is open, tap A is going to be again slowed down. So ultimately, the total quantum of money supply Reserve Bank is going to be very much concerned about. So to that extent, number one, the liquidity is not going to be allowed to go up simply because of this kind of capital flows coming in. Second, from the angle of rupee, my feeling, having worked in that desk in RBI for almost about, say, 7 to 8 years, is that Reserve Bank will not have a tolerance for a huge amount of appreciation of the rupee. So Reserve Bank would step in and would like to definitely curb its appreciation, because on the real effective exchange rate side today, rupee is fairly valued. Now, if you go back, actually, if you take the 2004-2005 days, I think India's 6 currency index as well as 36 currency index, they are actually very heavily overvalued. While we can actually take that base away from our discussion, 2004-5 being almost about 15 years back, but nevertheless, ultimately, when you look at this index, it means that vis-a-vis Chinese currency or vis-a-vis any other currency, Indian currency is still overvalued. But then if we have shifted the base actually as close as 2017, 18 and all, we are looking fairly valued. So obviously, I think we wouldn't like to move too far away from that fair valuation. So we would like to step in. So Reserve Bank would definitely step in to curb any kind of excessive appreciation.
We have got 2 questions from the viewers. First question to Mahalingam sir. Everybody is talking about positive of this. Do you see any downside of this also?
No, the downside, as I was mentioning is only from the policy maker's dilemma as to how to manage the rupee and all that. But again, I would go back to the panel. I think panel came up with good views that this should not be treated as a kind of a one-off event. It should be treated as a process, number one. Number two, even on the long-term kind of policies, I don't think we should keep stepping back every now and then. There will always be a problem of Asian crisis or some crisis here and there and all that. That can put us back by just about 6 months or 7 months or 1 year. It cannot put us back by about 15, 20 years. I think that's where there is a real problem as far as the policy is concerned. So I would say the downsides could be, if at all there is something about managing liquidity, managing rupee, these are something absolutely manageable from the Reserve Bank's angle. It should not cause a big problem. And even if there are outflows on account of India's weight going down, I would tend to look at the positives which are arising out of this weight coming down. Now, weights will go down unless, of course, I mean, if there are huge number of new entrants, India's weight may go down, but weights more often than not can go down because of macro policy mess or anything. So in fact, it would act as a check on the policy makers. It's a kind of an external disciplining mechanism on the policy makers. So to that extent, I would view that more as a positive.
I will just like to add one thing to what Malingamji said is about the weights. So just comparing with China, you know, since China opened their bond markets and since their admission into first emerging markets and now progressing towards the developed market indices in the bond market, the size of the Chinese bond market has gone up by 8 to 10 times. So you can see that even though other countries may enter, but if the size of the market grows, your weight stabilizes.
Okay.
Got you, sir. Thank you. Rajni, there's a question for you. Will inclusion have any direct, indirect benefit for non-corporate investors in the short to medium term?
So I'm trying to make sense of it. Non-corporate is what, for government, or was
I
it?
think there are people would be talking about a small size, individual basis, individual guys and all.
All right. So then there are plenty of upsides, and we've been discussing that. I think first is the yield curve as a public good. So once that happens, once rates go down, as Malingan sir was just saying, or once government has managed to find an alternative avenue for its borrowing, and then the crowding in of the private sector happens. But the most upside, I think, comes from the fact that if we do manage to raise some growth capital out of it and the demand conditions improve, so to that extent, there would be lots of both direct and indirect benefit to the small, medium enterprises. But if we are comparing sovereign to corporate in terms of gains specific to this kind of bond inclusion, then I think I'll want to point out that in countries like, let's say, Indonesia or Philippines, the spread of the sovereign bond has come down to the extent of 60 to 70 basis point over a decade, and the corporate bond, such gains are just 2 to 4 basis point. So, you know, it really depends on how we manage to place ourselves in the international growth scenario. So to that extent, if we are talking about sovereign versus corporate, I see very minimal upside, at least in the near term. But to the extent that we are talking about yield curve as a public good, we are talking about lower rates, we are talking about crowding in of private investment and hence growth capital funding, there are lots of upsides or benefits coming this way.
Thank you, Rajni. Yes, Siva.
The question was, what is the benefits to non-corporate investors? So I'm looking at it now from a investment returns perspective or investment risk perspective. And then if you look at it, okay, what does it mean for a retail investor? Obviously, there are certain pluses and minuses. And mostly I can see lots of pluses. Lower cost of capital for India means probably better equity valuation. Most retail investors are equity investors, will be happy. But I think as I said in my opening remarks, we need to see capital account convertibility as a two-way street. Today, if you are an Indian retail investor, you want to diversify your equity exposure, there are a lot of mutual funds which offer global equity investments. There is yet to be a single mutual fund in India which offers global bonds, right? I think there's a huge opportunity. We need to really look at it and this will happen, right? So as we get used to this whole capital convertibility, as we get used to foreign investors buying Indian bonds, the natural question will be, why can't retail Indian investors invest in a mutual fund which buys global bonds in much the same way that a retail investor sitting in some other emerging market can buy a bond fund which is whose benchmark includes India? Why not the other way around? So I think over a medium term, and now we're talking this kind of policy shift takes typically many years, requires a lot of policy action, but maybe Mr. Mahalingam can put in a good word to look at it from the policy perspective. But I think there is an opportunity for opening up foreign flows, overseas flows, both directions. And I think that's going to be the next opportunity for investors in a step like this.
Thank you. Thanks a lot. Thanks everyone for the panel discussion. I enjoyed thoroughly. And I now hand over basically to Bijur sir, and he will be giving a vote of thanks and summarizing the session.
Thank you, Pankaj, for moderating the session so well. And even I learned a lot from the discussion. It was not my subject, being a foreign exchange man, but we are in a world where integration is much talked about. And while inviting Malingam sir, I was hesitating whether for a webinar like this, Malingam sir to invite appropriate or not. Then I thought that nobody else can talk on this subject other than sir. And sir has a passion to contribute to the financial market developments. He has a passion, and I was looking him as a liberal regulator. And whenever the convertibility or anything relaxation to be asked, we will reserve that to with Malingam sir. For two reasons, Malingam sir is soft, and second thing is he's a market man. He was a chief dealer, and he knows what is the need of tradings and what is the need of reforms. He's always open to liberalization. Today also he was telling that we can't get better than time than this to open up, whether it's sovereign bond or global indices. I don't see any reason to keep this one. And I was rather very upset when sovereign bond was introduced. I thought, yes, something is happening, but it was blocked. And its time has come. And thank you very much, sir, for agreeing, coming here and sitting across the panel discussion.
Thank you.
Words fail me to acknowledge your contribution to Almas Rupee Money Conference and also to the overall financial market. Now, I would also like to thank Mr. Manish Gupta, Senior Research Analyst at FTS Russell, and he was there for our moderate call yesterday, and your in-depth knowledge and about how world looks, the market, how world looks India. India is lacking about its strength or anything. It's like that. Nobody knows about India. So even though India can do so many things, it's very real. It's very real about that. And about Shukumar, he was telling about the requirement of opening up from a corporate side, overall market side. I always feel that when it comes to market, there is a disconnect between government and RBI, and most of the time RBI controls the RBI stops government from taking few steps, and sometimes it is other way, and the government coming and intervening in regulators' approach and doing harm rather than more than viewing from a financial market developments. It's becoming sometimes a political decision, sometimes regulators being overcautious that deprives all of us in the financial market opportunities. So Shukumar talked about it, why it is required. Rajni talked more about macro. I don't really understand macro even now. So thank you very much. And all the participants who have made this webinar a success, to Ruchita for welcoming, and Refinitiv for sponsoring, being our sponsor partner for this webinar. Thank you, Pankaj, my colleague here. You have done a moderating very well. Thank you, one and all. And let us hope the market opens up and look for our Almas Rupee Money Conference. It is slated 3rd and 4th December. This time the topic is about how we all can contribute for the development of the financial markets. How to connect all people, government, Reserve Bank of India, and corporates, make this market more vibrant, and like what I have always been telling, that when we control whether it is gold or whether it is rupee, something else will emerge. Now also, if you keep shut crypto, I don't think it's a good development. That will hamper us. That will hamper the growth of financial markets. With this, thank you all. Thank you, Malingam sir, once again. Thank you all the panelists. Thank you.
Thank you.
Thank you.
Thank you all.